Welcome back to the Explainer. Today, we're taking a massive, thrilling leap forward. Now, if you've been following along with us, you know we've covered a lot of ground on various simple trading heuristics. But today we're officially crossing the Rubicon. We are leaving behind those simple single asset strategies and diving headfirst into the hardcore, completely fascinating world of portfolio construction mathematics. We are talking Markowitz principles, but heavily reinforced with modern statistical firepower. This, my friends, is where the real quant magic happens. Okay, let's dive into this. Here is our roadmap for today. We'll start with the evolution from heuristics to math, and then build our optimization engine using Sharpe maximization. From there, we'll tackle dollar neutrality via Lagrange, figure out how to actually survive adverse selection, and then we go to the alpha combo recipe to generate our tradable mega alpha. Let's go.
Section 1. From Heuristics to Mathematics, the Evolution of Quantitative Trading.
I absolutely love this quote from our source material because it shatters a very, very common myth. It says, profitability is typically not achieved by buying low and selling high each stock, but statistically, across all stocks, with some trades making money and some losing it. We're really upgrading our mindset here. We're no longer just guessing the direction of a single stock, hoping we get lucky. Instead, we're building a statistical factory that trades thousands of stocks simultaneously. Sure, some will win, some will definitely lose, but the underlying mathematics ensures that on average, the whole portfolio just relentlessly grinds out a profit.
Moving right along to Section 2, Sharpe maximization and statistical arbitrage, the optimization engine. Now, what's really interesting about this slide is that this strategy is essentially the mathematical engine of our entire trading factory. Let's break down this foundational math. It looks rigorous, I know, but the concepts are actually pretty intuitive. That first equation, that's your expected P&L, or profit, denoted as P. It's just the sum of your expected returns multiplied by the actual dollars you hold in each stock. The second one, V squared, is your portfolio variance. That measures your risk. And finally, we have S, the Sharpe ratio. This right here is the holy grail. It's simply your profit divided by your risk. The entire goal of this mathematical engine is to maximize S. We want to make that number as absolutely huge as possible. But to feed this optimization engine, we need raw materials, right? We have our expected returns, which are essentially our quantitative signals. Then we have our covariance matrix. This maps out exactly how every single stock moves in relation to every other stock. And we have our dimensionless weights, which represent the percentage of our total investment that we're allocating to a specific asset. You just input the expected returns and the covariance matrix, and the engine's sole job is to spit out the perfect weights. And here is the result. This beautiful formula perfectly fixes our dimensionless weights to maximize that Sharpe ratio. But hold on, there is a massive problem hiding in plain sight here. This mathematically perfect portfolio, it actually doesn't guarantee dollar neutrality, meaning we could accidentally end up with a portfolio that is 90% long and 10% short, which would leave us completely exposed to a sudden market crash. We really need a way to chain this beast down.
Which brings us to Section 3. Dollar neutrality via Lagrange, enforcing constraints in the portfolio. This is our elegant solution to unmanaged volatility. We introduce Lagrange multipliers. Now, I want you to think of these as our mathematical bouncers. We recast our entire problem as the minimization of an objective function, bringing in lambda and mu, and we basically tell these bouncers, do not let this portfolio leave the club unless the sum of the long positions exactly equals the short positions. They force the total weights to equal exactly 0. So, the crucial point is, when you apply those mathematical bouncers, you get this pretty daunting, closed-form solution for your new portfolio weights. Now, don't worry about memorizing the algebra here. I just want you to look at what it actually does. This formula automatically handles your risk management. It actively suppresses the weights of highly volatile stocks all on its own. It guarantees that our portfolio is strictly dollar neutral, perfectly balanced, and highly resistant to broad market panics. It really is a masterpiece of quantitative design.
Section 4. Surviving adverse selection, market making, and the execution problem.
Okay, so we now have a mathematically perfect portfolio on paper. But paper doesn't pay the bills. In the real world of live execution, there are two types of flow we have to deal with. Dumb order flow is uninformed, and capturing it is highly profitable. Smart order flow, on the other hand, is toxic. Imagine playing high-stakes poker and just laying your cards face up on the table.
That's exactly what a naive limit order does in the market. You say, hey, I'll buy at this price. And the informed, toxic traders who already know the price is about to crash will gladly sell it to you right before the floor falls out. That phenomenon is called adverse selection, and it will absolutely destroy a naive strategy.
Surviving this toxic flow requires a very specific set of tools. First off, you have to modulate your short-term limit orders with a longer horizon directional signal. Basically, even if you get run over in the short term by adverse selection, a strong long-term signal is going to rescue the trade. Second, you absolutely must have high-frequency trading, or HFT infrastructure. You are in a literal millisecond race against the smartest money on earth to place, cancel, and replace your passive limit orders before they can pick you off. Speed isn't a luxury here. It is survival.
Section 5, the alpha combo recipe, scaling up to the mega factory. This is essentially the final boss of our explainer, where we synthesize everything we've learned. And this brilliantly illustrates exactly what we mean when we use the term alpha in this context. Alpha is really just a set of desired portfolio holdings driven by a quantitative signal. It could be momentum, it could be a machine learning output, it could be a mean reversion or sentiment signal. It is the raw, unrefined material of our quantitative factory. But here's the catch. Having just one alpha isn't nearly enough. To scale, we need hundreds of them. To combine all these alphas, we use a very rigorous 11-step recipe, which we've grouped into 4 key phases here. Kind of like an assembly line. Phase 1 collects the raw alpha returns, serially demeans them, and computes their volatilities. Phase 2 normalizes them, cross-sectionally demeans them, and runs a regression against specific loadings, or lambda variables, to strip out any common market factors. Phase 3 extracts the residuals, represented mathematically as epsilon, which isolates our pure signal. And finally, Phase 4 sets the final weights and imposes strict normalization. The factory line is complete. Finally, Section 6, generating tradable mega alpha, reinforcing the math with statistics. So, what happens when you try to combine hundreds of signals using a basic standard sample matrix? Well, it breaks. It completely fails. Why? Because when your observation timeframe, which we call T, gets too close to your number of assets, which we call N, the matrix becomes violently unstable out of sample. It just generates massive errors. To fix this, quants bring in a statistical PCA-based covariance model. Principal component analysis cuts right through that noise. It resolves the mathematical instability, and it allows us to safely and robustly combine hundreds of separate signals into one massive functional matrix. And the end result is what we call the tradable mega alpha. Think of a single faint alpha signal like a whisper in a really crowded room. On its own, it gets completely drowned out by trading costs and market noise. You literally can't even trade it. But when you use statistical PCA covariance to combine hundreds of those faint whispers together, they synchronize. Suddenly, the whisper turns into a highly profitable roar. It becomes a singular, massive strategy that blasts right through the trading cost threshold and delivers pure statistical arbitrage. We've covered an incredible amount of ground today, transitioning from basic heuristics to the absolute pinnacle of portfolio construction mathematics. We've seen how Sharpe maximization, Lagrange bouncers, and PCA statistics all combine to create a true, unstoppable quantitative engine. So, I'll leave you with this question to chew on. How will you apply these rigorous mathematical optimization principles to transform your own faint signals into a tradable mega alpha? Thanks so much for joining me on The Explainer today. Keep learning, keep building, and I will see you next time.